I'm Stephen Neely, certified financial planner with Fortress Capital Advisors. I recently had a retiree come in and he was with a Morgan Stanley advisor and he wanted me to take a look at his portfolio because he was worried about the performance. And so in this video, I'm going to show you what I think is wrong with his portfolio, especially from a diversification perspective, and how to identify whether or not you're getting fleeced by your financial advisor. And if so, I'll finish by giving you suggestions of what you can do about it, and then I'll provide you with some alternatives that I hope could be helpful for you. So this guy, he's in his 70s, pretty conservative investor, and he's drawing from his portfolio. So the portfolio that this Morgan Stanley guy had set him up with, it was income oriented and, I would call it relatively conservative. And so all of that makes a lot of sense given the client's background. So I've thrown up here the investments that this guy had, and this is pretty common if you've ever seen a portfolio built by a financial advisor. So they tend to have all of these mutual funds and maybe some exchange traded funds thrown in there, and you really have no idea what any of these does, but you can kind of get an idea based on the name sometimes. Just off the bat, what strikes me about this portfolio is you have a lot of what you call A shares and C shares, but they're for the exact same fund. Both of them charge really, really high fees. One is a high commission up front, and the other one is like a high ongoing fee. So it's a bit puzzling as to why the advisor would do this. I mean, I have a few ideas, but in general, it's not a good first sign. The other thing that strikes me is that you have 16 funds, and you notice all of the names, right? You've got balanced and balanced and income and strategic income and income builder. So you can see that theme I've talked about, right? A lot of these are income oriented. The issue is that even though it might seem, somewhat diversified, most of these funds are taking on the exact same risk factors, and namely that's credit risk and interest rate risk and, to an extent, economic growth risk. And what that means is that they're all going to kind of move in tandem. There's a little bit of diversification in there with some gold, and you've got some oil and gas plays, and there's a couple of hedged equity funds, JP Morgan and Gateway. On its own, getting away from the whole A and C shares, none of these are terrible or stupid investments. I don't use any of them, but they could be totally fine. The problem here is that this advisor has all of these funds, but it's just window dressing. It's like I said earlier, these things are taking on all the same risks and they're going to move in tandem, which is what I'm going to show you. And so it's a way to make it look like you're doing something that is way more complicated than it really is. And what I often find is that a lot of financial advisors out there, they create portfolios that are over diversified, which actually detracts from returns. And so the first thing to think about if you're constructing a portfolio, there's two really main reasons for diversification. One is to make sure that a single bad investment doesn't blow you up. And that's pretty common sense, right? It goes to the old adage, don't put all your eggs in one basket. Number two, and this is the one that I think a lot of people miss, is that you want to add investments to your portfolio that complement each other. So there's no reason to throw a bunch of investments in there that all do the same thing, which is what this guy has done and what I'm going to show you in a minute. And I'll give you the reasons why it just doesn't really make a lot of sense, and it's probably going to harm you more than help you. So one place I like to start, kind of when I've settled on the type of investments that I like, I will run something called a correlation matrix. This gets into statistics, and I'm not going to hit you over the head with a lot of formulas, but you can think of correlation as a measure of how two things are related to one another and how much they move together or move in opposite directions. For positive correlation, you think if investment A goes up, investment B also goes up. If something is negatively correlated, if investment A goes up, well, investment B goes down. For correlation, there's a scale between 1 and -1, and how related they are, is any score in that scale between 1 and -1. So for example, if two investments have the exact same return, they would have a correlation coefficient of 1. If they moved exactly opposite, for example, if investment A is up 10%, then investment B is down 10%, they would have a correlation of -1. If things don't really move together at all, they're sort of just independent of one another, they would have a correlation coefficient somewhere around 0. When you're building a portfolio, what you want to do is add investments that have a correlation close to 0 or even negative. So when one zigs, the other one zags. And that's how you know you're getting a lot of bang for your buck on a diversification point. There's no point in having a bunch of investments that are all going to move in tandem. So this is the correlation matrix. Use my software here and it spits out this nice report and it gives me a good visual to see how much bang for the buck that I'm getting from having all of these different investments. This is the gentleman's portfolio that I mentioned earlier in the video. This is color coded. So red means they're highly correlated, very close to 1, basically no diversification benefit at all. The blue and purple ones means they're pretty independent and that correlation is closer to 0. If they were negatively correlated, the box will be coded in green, meaning like, hey, you're getting a lot of diversification benefit out of that. Just first things first, what you see in this chart is almost all red. There's only 2 investments here, the GLD, which is gold, and the MSUXX, which is just cash. Those are the only 2 things that really give you any diversification benefit. They're pretty independently correlated. Everything else is pretty much moving in tandem. And I don't want to suggest, look, nobody's going to be able to build a portfolio where, nothing is related at all. But this is just overkill. And it goes back to what I said earlier. There's just no benefit of having all of these investments that are pretty much doing the same exact thing. And I'll show you with some other tools here in a little bit how I know these are investing in pretty much the exact same assets beyond just this statistical measure of correlation. Now I'm showing you this. These are investments that I use, and I've blurred them out because I don't want to get in trouble for making specific investment recommendations on this channel. And by the way, things change and I don't use all the same investments all the time anyway. But the point here is notice that most of this is either blue, meaning, no relationship, or green, meaning they're negatively related, and you get a ton of bang for the buck as far as diversification is concerned here. And yeah, look, a couple of the investments, there's red there, right? They're related. You're never going to be able to have 0 positive relationship across your portfolio. That's not even realistic. And I know exactly why these are related, and they have very specific purposes, and they actually are different investments that do have a purpose in my portfolio. But the whole point of showing you this is it's possible to have diversification work for you, and if you run this on your own, it should look more like this than the last chart where it was just almost all red. Now, another tool you can use is something called a portfolio X-ray. And so that same gentleman's portfolio, I take all of the funds and you run a portfolio X-ray, and what it shows you is the overlap in the individual holdings. So this guy had 16 different mutual funds, and this X-ray shows me, okay, what are the holdings that are the same across all of these mutual funds? And it's pretty funny. So you can see 9 of those different mutual funds hold Pfizer. 9 of them hold Home Depot. 8 of them have Philip Morris. You might see a bunch of different mutual funds, but in fact, they're all investing in the same thing. Once again, a diversification fail. There's no reason to have your advisor put you in stuff that's all investing in the same thing. It goes back to that idea that I told you about window dressing, and I suspect this advisor is sort of taking advantage of this unsuspecting client who really has no idea what he's looking at, and why would he? The third way you can look at this and kind of know if you're getting any bang for your buck is just by looking at kind of more extreme events in markets where either you've had markets with a huge run up or run down in kind of a short period of time. I took this from COVID just to see, well, what did these investments do during COVID? because the correlation matrix might miss that, and it's not going to pick up maybe the extremes. And so here I can see every single investment in this portfolio besides cash was down during COVID. And most of them were down almost the same amount. The ones way far out at the right, those are the commodity investments. And if you remember, commodities just got crushed. I mean, the price of a barrel of oil was actually negative for a very brief period there. And so anything related to commodities was simply destroyed. If you look more towards the middle, almost all of those investments had nearly the same return. Minus 22, minus 22, minus 23, minus 23, minus 23, minus 24. And that alone tells me every single one of these is doing the exact same thing. There's no benefit in holding all of them. If you suspect that your advisor doesn't really know what they're doing, a simple way for you to check is, okay, after the end of a major day in the market, I would say look the next morning, because mutual funds don't price necessarily by the end of the day. So look the next morning before the markets open, see what the return was for all of these mutual funds the guy's in. And if they're all almost the same, you know that it's pretty much the same situation that this guy has done, this Morgan Stanley guy has done for, this prospective client. So now it gets into, well, if this is the case for you, what do you do about it, right? So if you suspect that you're over diversified for no reason, and you notice nearly everything is down to a similar magnitude or up, and you have an advisor, what you can do is you can ask for a correlation matrix and a portfolio x-ray. Nearly every advisor you go to is going to have the ability to produce these reports. You can look at them, and if you see a similar pattern to what I showed earlier in this video, you need to go to the advisor and say, hey, what's going on here? It looks like I'm over diversified. What's the reason for this? And if he gives you some reason that seems wishy-washy, like, well, you never know when something will outperform, I got to tell you, if the extent of the value that these guys are bringing in investing is just throwing a bunch of crap in a portfolio because they don't know when something will outperform or not, you don't need to pay an ongoing fee for somebody to do that for you, especially if there's really very little financial planning going on, which was definitely the case for this gentleman. So if you're comfortable investing on your own, then I'd say, hey, take over the account. If you're not comfortable investing on your own, what I would suggest is find a fiduciary, probably a certified financial planner, who charges hourly or maybe a flat project-based rate. Have them set you up a portfolio, and then you guys can just review it once a year. If you need planning in the interim, you can have that done on an as-need basis. The results aren't going to light the world on fire, but the reality is you're going to save a ton of money over time by not paying ongoing fees to somebody who adds no value from investing anyway. And so if you need to know where you can find a fee-only fiduciary advisor, there's two places I would suggest going. One is napfa.org. I think that stands for National Association of Personal Financial Advisors. And the other place is the feeonlynetwork.org. And both of these situations, you'll be able to find an advisor somewhere that charges either on a project basis or an hourly basis. So I hope that helps. I post videos every week on retirement and investing topics. So if you like that, hit subscribe and you'll get my video next week. Take care.